A covenant is an agreement for the loan that requires the borrower to fulfill certain conditions. The agreement gives lenders leeway in providing loans while still protecting their lending position. On the other hand, borrowers get clear expectations of the lenders. The loan covenant allows borrowers to prepare for their repayment before and during the agreement. However, in case a borrower defaults in payment or breaches the covenant, the lender is entitled to claim the sum of the loan in full. The covenant makes sure that the lender's rights are secure. There is a reliable mechanism to rectify the process, and there is a clear illustration of events leading to the borrower's default. In loan covenants, there are three commonly known types of agreements: affirmative loan covenants, negative loan covenants, and financial loan covenants. Affirmative loan covenants is a requirement to maintain a healthy operation of their business, which will in return create a stable financial performance. However, in breach of this covenant, the borrower may receive a grace period to fix the violations. Or worse, the lender may announce it as a default and thus demand full repayment. Examples of the lender expectation in affirmative loan covenants are: the lenders expect the borrowers to obtain dependable insurance policies for their businesses and at least extend it to the lenders as an additional insured party. To run a business in a bearable business environment, the lenders expect the borrowers to maintain a reliable working relationship with their respective states by enforcing and abiding by the laws. Sometimes the lenders may want to limit the borrower in decision-making regarding their business. To achieve this, they ensure that they own rights to notifications, like alteration of capital structure. It would be negative loan covenants. For this reason, it's important for borrowers to get a deep understanding of the term of the loan covenants to ensure they don't get unintended friendly crossfires, since lenders do not intend to lose their investment. Examples of lender restrictions in negative loan covenants are: the lenders possess the right to prevent mergers or acquisitions without proper notification or full knowledge of the process. The covenant includes a clause that prevents the borrower from investing without the lender's permission. Similarly, there is a clause that prevents borrowers from writing off or selling assets without proper lender's notification of the transition. The borrower must keep check of the durations related to service coverages. The lender may bar the borrowers from exercising stock practices like distributing and paying the shareholders. Financial loan covenants keep a guard over whether the borrower is reaching or closely attaining the targets of the estimates provided to the lender. Therefore, the closer to the targets, the more satisfied the lender is. Therefore, to be on the safe side, lenders may provide restrictions on the amount of credit the borrower may access at the given period or minimum cash on the bank account. We use only financial covenants in the challenge for Module 4. Examples of terms in financial loan covenants are: the borrower agrees with the lender that the loan-to-value ratio shall at all times not exceed 60%. The borrower agrees to maintain minimum cash balance $2 million and etc. If it reaches a point where a borrower breaches a loan covenant, the lender will undoubtedly take actions to solve the dispute. Sometimes the negotiations may be easy. In other extreme cases, it will involve stringent measures. Approaches in friendly dispute resolutions include: extension of period of submission. In the event the borrower fails to submit books of account on time, the lender, under stern warnings, may extend the period of submission. Offering waiver. On another occasion, out of goodwill, the lender may offer the waiver to the borrower. Debt buybacks. In case the debt is still feasible, the lender may prefer debt buybacks. That is, a lender may reduce the principal debt amount to enable the borrower to pay the debt at lower installment compared to initial amount. Legal agreement. The lender may offer the borrower a forbearance agreement binding the borrower to state when they will pay back the remaining amount in question. Out-of-court settlement. Sometimes the lender may not go to the extent of punishing the borrower with court cases. Instead, they may decide to renegotiate the agreement out of court. Amendments. Due to the conditions surrounding the operations of the business, the lender may choose to accommodate the borrower by amending a few clauses in favor of the borrower, providing equity cure. In this kind of dispute resolution, the lender may decide to approach the shareholders to infuse more funds to the business or add extra cash flows. Approaches in intense dispute resolutions are: first is liquidating the borrower's collateral. The lender may decide to liquidate the borrower's collateral held against the loan in case of default. So as a lender, you need to make sure that the assets used as the collateral are liquid. Second is insolvency. In case the business is no longer feasible, then the lender has no option except to push for insolvency. Insolvency is not the same as bankruptcy. Insolvency is a type of financial distress, meaning the financial state in which a person or entity is no longer able to pay the bills or other obligations. The IRC states that a person is insolvent when the total liabilities exceed total assets. The bankruptcy, on the other hand, is an actual court order that depicts how an insolvent person or business will pay off their creditors or how they will sell their assets in order to make the payments. A person or corporation can be insolvent without being bankrupt, even if it's only a temporary situation. If that situation extends longer than anticipated, it can lead to bankruptcy.